Hi. Let's learn about company guidance on earnings, including its impact and risks. Company guidance is an informal report that a public company issues to shareholders, detailing the earnings it expects to achieve in the upcoming fiscal quarter or year ahead. This guidance typically includes internal projections for revenue, earnings, and capital spending and is subject to revision in the interim. It contrasts with analysts' estimates, which are generated by external experts. Company guidance is typically released immediately after a company publishes its latest quarterly earnings report and is often discussed in depth during a meeting between industry analysts and company executives. While companies are not legally required to provide earnings guidance, it is common practice for many of them to do so. The information guidance is based on includes sales projections, market conditions, and anticipated company spending, among other financial activities. Providing forecasts to investors is a long-standing Wall Street tradition, and any comments management make about the company's future prospects are closely studied by investors. Guidance reports significantly influence analyst stock ratings, which in turn affect many investors' decisions on whether to buy, hold, or sell a stock. However, there is always a risk that a company's guidance may turn out to be wrong. Companies are protected from lawsuits if they fail to meet their forward-looking expectations through safe harbor provisions, and there is no obligation to update their guidance even if subsequent events render their projections unlikely. This can lead to a discrepancy between the initial report and actual earnings. Companies pair their guidance reports with disclosure statements to protect themselves from potential lawsuits and legal action. These statements maintain that their projections are by no means guaranteed. Some argue that providing less information to the public would not inevitably reduce stock volatility. Here are 4 key takeaways. 1. Guidance is a company's own best estimates to shareholders of its upcoming earnings. 2. It is usually published immediately after earnings for the past quarter and is the focus of discussion at a meeting between company executives and analysts. 3. Earnings guidance is used by investors and analysts to adjust their expectations for a company's share price. 4. Companies pair their guidance reports with disclosure statements, maintaining that their projections are by no means guaranteed, in order to shield themselves from potential lawsuits. Hope this would help. Thanks for watching.